What is going on, investors? Hopefully you guys are doing well out there. Something we don't normally do here on the channel. We're going to cover a stock that doesn't have a $130 billion valuation or a $1 trillion valuation. In fact, today we're going to look at a company called Toast Incorporated, ticker symbol TOST. Company sitting at about $13 billion valuation, although based on the performance of the Q1 results, maybe going higher tomorrow. Today's video, I think you're going to learn a lot. First of all, these smaller companies that are not profitable from a GAAP perspective, from a cash flow perspective, they're kind of exciting, but you gotta get them at the right time. So we want to ignore stocks like this during kind of a hype phase when everybody's kind of piling into them. But then you get this washed out phase, and then the company starts to turn the corner. I'm going to show you financially, this company looks like it's about to turn the corner, and that's one of the reasons why shares have performed relatively well over the last year, up 21%, and year to date up 29%, but there could be further upside to come. Also, I want to emphasize, if you're looking at your portfolio and you're overloaded on the companies like Toast, like Palantir, like Upstart, like SoFi, you're doing it completely wrong. These should make up a very, very small portion of your portfolio, but it can be an exciting portion of your portfolio because these stocks, if they execute well, can obviously really grow into a huge, huge valuation. We'll talk about the growth here in a moment. But those Q1 numbers came in. We got $1 billion worth of revenue. Our mega cap stocks that we cover do this every 30 minutes or so. But that was enough for nearly 32% growth year over year, beat expectations by about $40 million. Now, the company also raised their guidance really for all of 2024, not just kind of on the gross profit side, but also they're using a lot of adjusted EBITDA numbers. I'm going to show you, you don't have to adjust anything over at this company and really start to project out into the future. Also, this company operates in an interesting business model. They provide these self-service kiosks to fast food chains, and out here in California, they had the genius idea in an inflationary environment to raise everybody that was working at a fast food restaurant from a $16 minimum wage all the way up to over, I think, $20. And so a lot of these fast food joints are having to adjust by lowering costs, maybe installing some of these kiosks. Now, the company is also expanding into other services like websites and mobile ordering. And so this is a company that could continue to expand. When you look out into the future, solid revenue growth in the most recent quarter, over 32%. It looks like for subsequent quarters, we're going to start to normalize kind of in that mid 20% range. But really, you're looking out for another year, year and a half, where on a quarterly basis, you're going to be printing about $1.5 billion to that revenue side. Annualize that number out and you get to $6 billion. So it makes this $13 billion valuation, which is big on a forward earnings basis. We'll have to ignore that a little bit. And even on a sales basis today, you start looking out a year, year and a half or so. Well, all of a sudden, if they're able to execute on that, certainly a company that could grow into that valuation. And if the trends continue in the industry, well, they can blast up over and above that. What you're looking for with these small companies is you don't want to invest in kind of the early hype stage. This rarely works out. Now, occasionally it does, but it rarely does. It's not something that you can consistently repeat. You really want to put these stocks on your watch list and revisit them a year or two after they go public. And that is the case with Toast. And you've seen over the last year, our total revenues ticked up to this slightly over $1 billion. Again, that was 30% growth, north of 30% growth. Now, they have the subscription service business. This is very, very high margin off $151 million worth of revenue, just $50 million of costs. You have your fintech solutions, $873 million in revenue, $683. This reminds me of kind of like the Shopify for restaurants, if you will. Shopify's financials, at least in the early stages, looked very, very similar to this stock. You see our total cost of revenue, so a slightly over $1 billion in revenue. We had $826 million in costs, so our gross profit came in at $250 million. Last year was closer to $175 million. Now, we've got other expenses as well. I noticed sales and marketing didn't tick up a whole lot. We grew our sales by over 30%, and our sales and marketing only ticked up, we'll call that about 7 to 8%. Research development actually went sideways. Your general administrative cost actually went down. This is exactly what you want to see. We did have some restructuring expenses as well, which we'll assume not repeat, maybe not necessarily next quarter, but next year. That was the tune of $41 million. If you strip that $41 million out, your loss from operations operations was almost negligible. It's at a negative 56 million. Last year, you're at negative 92. So minus the restructuring, you're almost at break even. In fact, you'll probably achieve almost break even from an operating profit perspective, either next quarter or the following quarter. That is a turning point. When you go from a money-losing company to a break-even, near profitable company, and on top of that, you're doing it while you are maintaining and starting to flatten your expense cycle, that is a very, very good sign. The company, from a balance sheet perspective, has plenty of cash on the balance sheet, and as you'd expect, company that just more recently went public basically has very few liabilities. So nothing to be worried about from that perspective. Now, from a cash flow perspective, we get a 3-month view on the cash flows, pull down our net loss. We get to add back things, subtract some things. Last year, we were at a negative 55 million. Again, we're getting to that turning point. Your net cash provided by your operating activities, a negative 20 million. You're looking forward a quarter or two when you tack on another 25, 24% growth in subsequent quarters, where you're looking at maybe positive or at least break-even cash flows. The reason why that's important is this is one of these companies, they don't have a lot of capital expenditures. Being primarily a software company that does sell some hardware, not a lot to invest here, and so that's exciting, and then also not a lot to do on the investing side. They're continuing to issue stock as a way to continue to raise money. Overall, the financials obviously aren't great. This is not Google, this is not Microsoft, but you're definitely looking at a company that is turning the corner. And when you're looking at these small companies to round out your portfolio, you've already got full positions of Microsoft, Google, Apple, Amazon, those types of companies, and you want to round it out with some fun companies that could 10x over the next 4 to 5 years. You're looking for this turning point type of stuff because it becomes you have a much greater margin for safety, as these revenues are relatively predictable for this company. They have annual recurring revenue as they've signed these restaurants up, and you see ARR, which is annual recurring revenue, as of March was $1.3 billion. That was up 32% over the last year. You continue on that type of pace, even if you start flatten out this growth rate, you're going to get north of $2 billion very, very quickly. In fact, in just about 2.5, 3 years or so. So things are looking pretty good there. Also, technically, we're looking pretty good. If you bought this one on the hype cycle, just chalk that up as lesson learned. You're not going to do that again. You're going to wait till the kind of the excitement rushes out of these companies, and then the reality starts setting in and they start getting to work. More recently, we've been making a series of higher lows, higher highs. I am on a weekly chart. We are at the top of the channel, so I wouldn't be like overly excited about starting a position here, but I'm looking for one of two things. I'm looking for a breakout to the top of the channel and above the channel. You'd like to see maybe potentially over the next week or two, a breakout above really shows you have a lack of sellers that have materialized in this $24, $25 range. They've materialized back in February 2023, also in July of 2023, also more recently back in March. If those sellers don't show up at this level, well, you have a breakout. Wouldn't necessarily chase the couple candle breakout that you might experience, because often what you have is a back test to the top of the channel. That's my first area where I'd grab shares. With these smaller stocks, a stop loss is so important. Some people laugh at me when I'm talking about stop losses. You gotta have them on these small stocks. I'd like to have mine maybe being very generous, maybe at about $21. That's because if you return back, let's say even if you break out of the channel, you could come back into the channel. You come back into the channel, you're probably testing areas much lower. There's a clear area where I'd be very excited about getting shares, and that is the other scenario. Instead of the breakout over the next couple of days, more likely is Toast actually gets rejected at the area it's at, and you pull back to this area right around $18, $19. That's the area I'd be really targeting on this one. Get broader pullbacks in markets. These small cap stocks certainly will underperform. Well, folks, that was Toast. Small company, certainly not going to go overweight this one, not going to sell your Apple shares or your Microsoft shares to buy this one, but you got an extra $100 in your Robinhood account and you've got $50,000 in your IRA. Well, these are the type of companies that you take those small shots on, and you certainly can learn a lot. You can learn a lot of discipline if you followed the technical analysis discipline that we outlined. Also, when you're looking at these small companies, make sure they're at a turning point financially. The turning point financially comes when their operating expenses start to flatten out, where you're not seeing that exponential growth quarter over quarter, even month over month. And then on top of that, your losses from operations are turning from maybe just slightly negative to close to break even. And this company, minus the restructuring charge, is pretty much there. Interesting company, interesting trend. Gotta feel like it's a trend that is going to continue, at least for the next several years. That was Toast, a first here on the channel. Hopefully you guys enjoyed today's video. Hit that like button, since a video like this probably not going to get a ton of views. Thanks for tuning in. Good luck with your investments.